Good morning, everybody. It is December 27th, 2 days after Christmas, and we're going to talk a little bit about the new VSL, a couple of new pieces that Shooter is doing, basically splitting his other piece into two parts. So let's start with the VSL. I hope everybody had a great holiday. Ours was pretty good. Two 93-year-old grandmothers hanging out with, so interesting stuff. The things that come out of their mouths at those ages. Also, my grandson is starting to talk quite a bit. So he tried to tell the dog to sit. So you can imagine how that came out. All right, let's take a look at the new VSL. I have updated it a little bit. In particular, the thing you're going to want to pay attention to, and I will have a tutorial video at some point, is you want to pay attention to the buy zone, and you're going to want to learn how to use it. Top of the buy zone is basically where it looks like we can get a pretty good buying opportunity. But of course, if there's major downward momentum, we have to take a look at it at that point. Markets overshoot all the time to the top and bottom, and that is just something that you have to learn how to deal with. It doesn't usually have anything to do with fundamental value. The fundamental value of a company today versus, say, a year from now versus, say, 5 years from now is a moving target, and the market is not very good at getting to an appropriate target and then hanging out in that region. Usually, price goes way below or way above what fundamental value is, mainly because 80 to 90% of people have no idea what they're investing in. They're just chasing numbers. So that's why we can get very good bargains from time to time during rolling corrections, which at the start of 2021, that was one of my main predictions, is that we'd have rolling corrections throughout the year, and that's what we've gotten. Markets also overshoot quite a bit on the hype, on the overexuberance, on the irrationality, and that is when we can get profits that probably shouldn't have come for years based on fundamentals, but because the market bids something up. Right now, of course, we know that the entirety of the large cap market is pretty much bid up to record levels. So you have to pick out what is headed in the right direction, what's headed in the wrong direction. And I think it's pretty clear that our investment barbell has generally been right. So you want to be very wary of capital intensive companies unless there's a reason to be in them. For example, company on the right side of the energy transition that happens to be getting massive government tax breaks. So we'll talk about that in a little while. Bottom fishing price, right? This is a price that is fundamentally cheap. I generally look at it as a 30% discount or greater, 30 to 50% discount. Prices below the bottom fishing price signify an Armageddon pricing. And that, again, is just the market overshooting. Risk level, I'm adding this to the VSL so that you have an idea of what level of risk you're taking. Speculative means that it's a stock that could, in fact, go to zero. Not many of those on our list, but there are a handful because if their plans materialize, you're potentially looking at 10, 20, 30 baggers. You have to decide how much, if any, of these speculative stocks you want in your portfolio. High-risk stocks can suffer long-term losses in excess of 50%. So a stock trading at 100 today, 5 years from now, could be 50. That'd be the easiest way to understand it. A market risk, intermediate term, over the next 2 to 5 years, could have losses between 20 and 50%, but in the long term, generally will erase those losses. And then a low risk stock, I would consider in the intermediate term, 2 to 5 years, very rare that it would ever hold losses greater than 20%. So we take a look at a stock like Apple. Apple is a low risk stock. Now, can it drop 20 or 30 or 40 or 50%? It can. But in that 2 to 5 year window, it's unlikely that those losses would be maintained. So unless you sell the bottom of the market, you generally are going to get your money back on a low risk stock. Now, most low risk stocks don't have much upside. Why is that? It has nothing to do with greater risk means greater reward. That's the biggest bullshit out there. You want low risk and market risk stocks in most cases. The high risk stocks you trade, but the low and market risk stocks, in simplest terms, those are companies that you can buy and hold for an extended period of time. And if they happen to go down, you can add, but you don't need to panic sell. So I want people to get it out of their head that risk is the way to make money in the market. I see that over and over again. I've seen it in our chat rooms, and it's bullshit. You manage your risk and the returns will come. And the reason the returns come is because if you're smart, you're looking for asymmetric upside. You're looking for stocks where the potential upside is far higher than the potential risk. So when we look at stocks, when I look at stocks, I'm looking for stocks pretty much across the board that will triple or at least have a very good chance of tripling within 5 years on the total return basis. I can live with a little bit less than that on, some of the low risk dividend stocks. But for the most part, I want triples or better. And when I can find something with a market risk, basically the same downside as the S&P 500 during the next 5 years, but it's going to tell me, wow, the upside here is a potential 5-bagger, 6-bagger, 7-bagger, 10-bagger. I love that. So you need to use volatility to your advantage. Remember the Karate Kid? You use somebody's weight against them. It's the same thing with stocks. It's the same thing with poker. It's the same thing with a lot of things in business, in relationships. Use the volatility to find the spots where you should invest or raise or make a proposal. And if you can embrace the variance, if you can embrace the volatility, you'll be a much, much, much better investor. The 5-year X score, this is the good execution result of a stock off the bottom fishing price. So if the bottom fishing price is set at 10 and the X score is 10, that means that I see the stock could go to 100 if everything goes their way, if they execute, markets cooperate, things like that. Those are built primarily with just basic modeling, financial modeling. You can go to any stock report from your brokerage, pick out a company, and they'll show you their modeling. At least some of the analysts will show you their modeling over the next several years. Usually up to 5 years, they'll go out and they'll do projections of revenues. Well, I look at those and I try to find where they're wrong. Where are they really low? Where are they really high? Because if they're about right and the market agrees with them, it's an efficiently priced stock and there's not much point to investing in it. It's already efficiently priced. But if the analysts are late to the game, and on small caps they usually are, and mid caps too, you can basically just look at the hype cycle, which we've been through a number of times, and say, okay, there's 2 times to invest in a stock that's going to have a great future based on their technology and their business model and whatever else it is they're doing. Right at the outset, there's going to be a lot of hype. You can identify that pretty easily. But then the traders trade it up really fast, usually within a year or two, and the thing starts disappointing. Why does it disappoint? Because people have irrational expectations. They expect things in 2 years that are going to take 10. So then the stock crashes for a year or two. And then it starts to jitterbug around and find its grounding. Over that time frame, the business starts to do the things the business is going to do. And now you're 4 years or 5 years in. You get what's called the slope of enlightenment out of the valley of despair or valley of death, depending on whose chart title you like. And it's the same thing over and over and over again. So you take a look at some of the stocks that ran up during the coronavirus boom, and it was meme stocks and SPACs and a bunch of other things. And now they've been crashing for the better part of a year. And you go, a lot of these stocks have almost round tripped or even overshot. And so you should really ask yourself, which companies are going to execute? Which companies have the momentum in their business that is just going to keep going their way? And that's where you are in the small caps, which is why I wrote that article last week. There's a lot to be interested in the small and mid cap space. Large caps, they're continuing their rally at the moment. I don't know how long that'll last. They're at record overvaluations, and the Fed is withdrawing support. Now, something to keep in the back of your mind, and I'll write a piece on this. The Fed has $1 trillion of hidden quantitative easing money for down the road. What do you mean? What do I mean? What do you mean? What do I mean? The Fed has $1 trillion stashed away to support the repo market if it needs it, and certainly it will need it. But they've written the rules a bit so that it shouldn't trip into the market as much as it had been. They're going to let somebody go out of business. I don't know who it'll be, but it's not going to be protect everybody. It's going to be protect good companies from getting dragged down by bad companies. And the bad companies are going to be allowed to get eaten up, whether they're hedge funds or banks or whoever they are that are using the repo market. So you shouldn't expect as much benefit from repo market QE as we got the last time in September of 2019 when Powell did it then. So if you go to the VSL, see that I've been working on this. A lot of updated charts, spec level or risk level, spec on AST Space Mobile, right? The stock that can go at almost nothing, but I just couldn't bring myself to put 100 here. But this could be $100 billion company at some point. I just put 50. Because I thought you'd think I was insane if I said this can go up 100-fold, but it could. That's how important their technology is. If it works, oh my gosh. And in fact, it would be pretty amazing for companies like AT&T, which would suddenly become a global 5G company. And at that point, if this works, you probably see consolidation in the domestic carrier space, because now you'd have the ability to send a 5G signal from a satellite to a cell phone, not a ground station that you have to build and throw Wi-Fi off of, to your cell phone wherever you are. There's a difference between Wi-Fi and a direct cell signal. They're already sending the signal from the ground out to space and hitting the satellite. Now they have to reverse it and send the signal from the satellite back to a handset that's moving around. So we'll see if they can pull it off. My suspicion is that when AST Space Mobile launches in summertime next year, they're doing it through Musk's company, SpaceX. I think it's going to work, but it might not work the first time. So that might mean that we have to be very savvy with how we handle this position. As you go down, you see different stocks with market risk. Discovery, roughly market risk from here. It's below its bottom fishing price, but from 27, I see it having about 9 times upside. And it could actually overshoot. I mean, could it gain so much traction that it becomes the next Netflix? I doubt it, but like I said, I think it at least do as well as Disney. They do have another Game of Thrones series coming out once they're merged with Warner, so that's probably a big deal. One of the companies on the list that somebody in chat was throwing up a bunch of hit piece links to is Aemetis. Aemetis is a company that has kind of a virtuous cycle in biofuels. They are taking the carbon from dairy farms and from orchards and recycling it in the fuel. They're recycling that carbon rather than putting it into the atmosphere. They put it into natural gas and into diesel. So how good is this? Well, they have cut 3 deals now. One with American Airlines, worth $1 billion. They did one for Delta first, another $1 billion deal. And they just did a 450 million gallons of renewable diesel with an industry-leading travel stop company. And because of where they're located, it'll be in California. So what 2 companies could it be? I mentioned one of them in our call that I did with the CEO last week that I'll edit this week. Well, these are the Travel America locations in California. And these are the Pilot and Flying J locations in California. Warren Buffett owns this company. This is a stock that I told you about when it was single digits. So why do I like Aemetis, given that it is undoubtedly a capital-intensive company? It's because they are doing something that Kinder Morgan did years ago. They are not borrowing a ton of money. They have credit lines with a company called Third Eye, and they are giving Third Eye some equity in the company. They have 500,000 warrants out there. But what they're doing is they're not doing these deals on spec, right? Like with a spec house, you build the house and then you look for a buyer. That's not what they're doing here. They're finding the buyers, and then they're building capacity to satisfy the buyers. They're getting a lot of money from the government to do this, and there's tax incentives as the fuel is produced and sold. Somebody on one of the chat boards came out and said, "Oh, look, there's hit pieces on these guys. They're too risky." Well, I don't know. Do you think those hit pieces are smarter than Delta, smarter than American Airlines, smarter than either Travel America or Warren Buffett's company? You decide what you want to decide. I'm not going to argue with you. I get tired of arguing. And I'm not going to try to convince you to buy anything. I don't know exactly what price we should buy Aemetis at, but I suspect $11 is about where it can get to, maybe 10, but not much lower. Why? Because we've already got the contracts in place. And next year, if Build Back Better gets passed, and it will, it's just a matter of in what form. Manchin already sent back his ideas that, here, if you do this, I'm good to go. And then Sinema's going to throw a fit and they'll have to give her thing. But there's additional tax credits at the federal level for these guys. So you can believe a hit piece that clearly has a vested interest in shorting and probably accumulating at the bottom, or their friends accumulate at the bottom. You do know that's how the hit pieces work, right? I've been asked to write hit pieces, and the hit pieces basically go like this. There's somebody who's late to the game on buying a particular stock. So they go to their buddy, the hit piece guy, write some hit pieces on this company. Here's some research to help you, point them in a direction. Here's how you can say things that'll scare people. Stock goes down a little bit. First company, first manager gets to buy in because he missed it the first time. They both make money, right? I'd love to have a database of where everybody's golf club is. And you know who's talking on the golf course. So anyway, the company that is one of the major financiers of Imetis is Kagan McAfee. These guys have financed about a dozen companies over the years. And part of the hit piece on it was, they've had a couple companies that didn't make it. Yeah, fucking A. That happens. You do hard things. Sometimes things don't work. One of the things with Imetis is not that they have first mover advantage in California, is they actually have only mover advantage. So that's about as good of a moat as you can get. There are no competitors of them right now in California. They'll probably be the only supplier of jet fuel, alternative jet fuel, to the San Francisco airport and maybe Vegas, maybe Portland, maybe Los Angeles. They're right in the middle of San Francisco and Los Angeles. So it wouldn't take much to get that pipeline to both places, to get the fueling to both places, actually trucks. One thing to keep in mind, this guy, so one guy that I talked to, he's a lifelong farmer. He knows most of the people in the Central Valley in California. And that's why they're signing up so many farms, because he's a farmer with an interest in the area, and he's helping these guys make more money and have lower expenses. Pretty good deal if you're a farmer, right? Because farming's hard. So if somebody says, hey, I can lower your expenses and increase your income, you're going to listen. This is what I'm doing with my farm. Do you want in? And I don't know how many farms they're up to now. I know it's over 18. And they're big farms. I mean, they're not like 40-acre farms. They're 160 acres and up with orchards and or cows. All right. So as you go through here, like I said, I'm getting all these charts updated. And I'm also, at the same time, I'm doing the financial modeling on a lot of these. So I've done the financial modeling if I have a 5-year score in. This is going to take a while. The risk level, I can kind of look at the charts and the balance sheets and know. So basically, if it says high, it means that they're either not making money yet or have a lot of debt. In most of the biotech cases, they're not making money yet. And again, on biotech, this is part of an article I'll write for you that I told you this is going to be building your health portfolio, building your biotech portfolio. In most cases, for most of you, you should just buy a biotech fund after it gets beat up real bad. Because the thing that we have to keep respecting is the cycles, shorter term cycles within the longer term secular trends. So think of the secular trend as kind of a pathway that either is going a little bit up or a little bit down, right? A channel. Think of it as a channel with the slope up or the slope down. If the secular trend is in your favorites, the slope is up. But the cycles within it run like a sine wave. So you want to buy the bottom of the sine wave, sell the top, or trim the top. With a secular trend that's against you, like oil, you have the channel that's already pointed down. We know that from the 250 companies that have gone bankrupt in 6 years. We know that because in Asia, they're never going to reach their 2019 levels of oil production ever again. The United States might never reach its 2019 levels of oil production ever again either. OPEC is probably the only one that's going to see higher levels of production 2019 to the middle 2020s. Why? Cheapest oil wins. But in the cases of biotech, we know that the trend is up, so we want to buy the big cyclical corrections. In the case of oil, we want to sell the rallies. And at some point, the secular trends that are against you, they don't go linear in a linear fashion anymore. They start to bend down even faster, which is why I've cautioned everybody against oil, is because we don't know how fast that's going to be. We know that Saudi Arabia and OPEC is probably going to win because they have the cheapest oil. We know the transition is going to take time. And ultimately, Chevron is probably the strongest American major. Exxon's got problems. They can't acquire anybody and they have no market to sell anything. They're selling some natural gas, and that's probably a bad idea, but they need the money to preserve their dividend. I think they should just cut their dividend in half. Keep the natural gas assets. Chevron is the biggest player in California, by the way. So Imetis is a takeover target for them. So that's what I'll do here. The dividend side will do the same thing. Most of these will be lower or market risk. But again, it's going to take me some time to get that done. Shooter's weekly report got broken into two pieces. See here, it's a risk review and swing trading notes. Now it's swing trading notes and major markets, ETF risk on and risk off. So let's take a look at that. And this will be available to all paid subscribers. And a modified version of this will be on margin of safety, not the trades, but just the broad picture. And I'll add some commentary. So he talks about where these charts are. I think the S&P 500 monthly is the one that we'll look at today. Again, if this peaks out and starts to fall, there are different levels that it can fall to. I think it's pretty scary what could happen. If the Fed doesn't really care about the stock market for a little while, and they really just want to shore up the dollar and clean up some debt, the stock market is going to get hit. Now, it would be the buying opportunity of a lifetime again. We're starting to get too many of those. Right? It shouldn't happen every few years. But 2018, 2020, the fact that this is an open megaphone here, right? It's a shape that you should look at. Means that it can go even lower. I don't think that we see an S&P 500 around 200, which is basically a 200-day moving average. Should tell you how fast it's moved. And this is almost the definition of irrationality. But it was fueled by quantitative easing and people just deciding that, hey, the Fed's only going to let the stock market go up. We'll see. I happen to be in the camp that I think that it bounces around for better part of the rest of the decade. Not that we won't hit some new highs, but I just don't see much in the way of gains, the S&P 500, through the end of the decade. 600-ish, guess probably be the high at some point. That doesn't mean that we don't get into the 200s between now and then. And then, of course, Shooter has his swing trading notes. I'm not going to show you too many of them. I'm just going to show you Apple. So he talks about Apple. And Apple is the one that everybody's pouring money into. So if the market has a little bit of rally left in it, Apple's probably going to be one of the leaders. But you can see that there's not a ton of upside here. $20, so that's 10%, 11%, 12%. It's getting very hard to find smart places to invest. Warren Buffett bought way down here. He told everybody he's not really interested in buying any more way up here. And they've trimmed. They've trimmed a couple times. So if you're going to trade Apple, here's the one that I would trade. And the reason being is that if the trade goes against you, like I talked about at the onset, you can just hold on to it and time will fix it. So if it turns into a bad trade, it'll still be an okay investment. You just have to let time fix it for you, or you take your loss and get into another trade if you're a great trader. Shooter can do that. Most folks can't. But if you're at Fundamental Trends and you're in the chat, they're talking about it. So they're talking about all kinds of stuff. All right. Any questions? Somebody asked about Ametis. Is it a trade or a long-term investment? Well, airplanes are not going to be electric anytime soon. So they'll be running on jet fuel for a very long time. So the jet fuel that is provided by Ametis probably has a 20 to 30 year window. The truck fuel probably has a similar time frame because I've come to the conclusion that you're probably not going to see electric over-the-road semi-trucks anytime soon. And there's two reasons. One, the tractors can't have enough power to pull a trailer a super long distance. They'd have to have batteries on the bottom of the trailer. Well, that cuts the amount of space for cargo. Can't have that. They cut their cargo by 15%. That's less money that they make. The other thing is time management. So we know that trucks, EV or not, in a geo-fenced area can operate with somebody who's not a CDL driver, right? Somebody without a CDL. And that means that they still need to fuel quickly. Otherwise, they lose time on the road. So it really, in essence, doesn't even matter if there's a driver or not a driver. But if it takes hours to charge a giant truck versus 10 minutes to fill it from a hose, which one's going to win? So from the standpoint of capacity and time management, it's very difficult for EV semis to make a lot of sense other than very short trips. So like if a truck is going from one side of town to another side of town or something like that. So I think that the semi trucks are probably going to run on modified diesel for a long time. That's my guess. Because I haven't seen the advances in the last 2-3 years tell me that they're getting to the point where they can maintain the capacity and charge them fast enough. It's not a car. It's like 30 cars. It'll take a while to charge them. So I'm going to write a piece on alternative energy this week. I'll cover some of our stocks and a couple of ETFs. That'll be how to build your energy bucket. And then you can decide which stocks you want to own, or if you just want to own a couple of funds. I think that the stocks have so much upside, you're going to want to have some stocks around a core fund position. And the build your bucket pieces, generally you're going to want to own some stocks because there's big upside. With the exception of emerging markets, if you just want to own emerging markets funds because you don't want to manage foreign stocks, I get it. But Jumia, Stone, things like that, so much upside that I think that you sprinkle those in with the funds. So I will get to all that this week. As far as option selling goes, I'm selling puts out to February. So if there's anything that's near a bottom fishing price, and I'd really just be focusing on bottom fishing prices if you're an investor, I'd be selling February puts basically at the money if you're close to a bottom fishing price. But whatever price a stock is at that you're interested in, the strike price minus the premium should get you down to about the bottom fishing. Somebody asked, am I likely to look at Wejo? Yeah, I'll look at it. Only so many minutes in a day. All right, so let's call it a day. I will get this up tonight. I will work on the Metis interview this week and probably have that out on Sunday, maybe Monday. I don't know, early next week sometime. All right, take care.